Hi, everyone, and welcome to our webcast with BlackRock. My name is Natalie Samarco. I am a director in market development for Refinitiv, focused on emerging technologies and Refinitiv Labs. With me today is Francisco Rosenberg from BlackRock, whose focus is in client centricity in the LATAM region. And today we're going to be speaking about new investment criteria and trends during and within COVID-19. So we hope you all enjoy the webinar, and we should be timekeeping this so that we can get you out of here in a timely manner. So thank you and enjoy. First, we want to go into what we're going to be talking about today. First, I'll talk about some market trends that have been happening since COVID-19 and what are the drivers within financial services and wealth management. Then we're going to let Francisco display his expertise, and we'll follow up with a Q&A since we have him on the line. We're very pleased to have him. So thank you, Francisco, for being here.
Thank you, Natalie.
Thank you. Now, we want to kick off here by setting some context. And as everybody knows, there are so many market effects that have happened since the onset of COVID-19. And since March 1st, which was just 10 weeks ago, it seems like the world has completely flipped on its head. And I don't know about any of you, but now my friend groups, my family are all now all calling it the old world in which we lived in, because COVID-19 has very much made it the new world. But I wanted to touch on some areas of where we are now. And the first point I want to make is infection rates were spiking immensely throughout April 2020, but now we see them coming off a little bit, and that's very encouraging. The strains on the healthcare system were on the lips and the minds and the hearts of every nation around the world, and at least in New York, where I'm based, we've been every day out there applauding the healthcare workers, and I'm finding that it's similar in other countries around the world too. Just the thankfulness of people who go in and into the hospitals every day and work with patients and families and face unprecedented circumstances with those that have contracted COVID-19. That said, I have talked to a doctor friend of mine who also gave some encouraging information where there are more discharges instead of hospitalizations, and they are seeing ICU beds more and more open these days. Additionally, there are government-mandated lockdowns. This is affecting every region: APAC, EMEA, the Americas. The government-mandated lockdowns, they lead to extremely sudden and highly synchronized economic shutdowns, business closures. Many of the supply chain disruptions are often on the minds of our customers and clients, and it really has led to a contraction in world trade activity. Next to last, the oil price war. Now, this really heated up in March and April, but the oil price war, which was ostensibly between Saudi Arabia and Russia, has had a large effect on global oil and gas prices. And then lastly, the media coverage. I'm pretty sure no one can open a phone or turn on a radio without being bombarded by the veritable torrent of media coverage. This includes press conferences, medical advice, conspiracy theories, contagion sagas, and of course, economic forecast and disease progression modeling. And oftentimes, they are dire and even apocalyptic. So as we take note of where we are now, what we've done here is take consideration of what are the factors of the bull and bear case related to COVID-19. So let's start with the bear case. And these are worrisome factors that could lead to the bear case. So before we had the virus and we had sort of an open economy and we were almost living in bliss is what a lot of people describe it as. Now we've woken up, and there's consumer and corporate and investor confidence that's been deteriorating due to this news flows. And there are persistently elevated concerns about the likelihood of a recurrence of COVID-19 once we get on the other side of it during the spring, perhaps. And so now there are concerns about what is reopening going to look like in the face of the concerns of perhaps a resurgence or recurrence. Secondly, GDP results and corporate profits could exhibit extremely poor results in 2020. That is not news to any of us, as we've already seen the companies in the S&P 500 and many different markets around the world report in April their first quarter earnings. And that is leading to a more protracted and feeble outlook for 2021 for these companies. Additionally, Saudi Arabia, Russia, even U.S. producers have agreed. They come to an agreement to limit gas production, but crude oil and natural gas prices are remaining significantly low. And I checked this morning where gas prices were gas price futures for West Texas International were about $25, but we're all pretty well aware that they went negative for the first time in not too many weeks ago. So that's an encouraging factor, but it is a little bit in the bull case because there is still pressure on gas prices. And then lastly, I'm seeing that for the bull case, a major factor is societal cohesion and confidence in authorities has really deteriorated. And the erosion has had, honestly, a harmful effect on identity of nations and shared values and trust, reciprocity, and even productivity. So that said, that is the bear case. But let's move to something more positive with the bull case. We see some constructive factors here. We see it through antibody testing in Gilead, Regeneron, and companies elsewhere around the globe are starting to test on humans now. And so there's hope there that all of the practices, not just from these companies that are developing testing and vaccines, but the social distancing, the quarantines, they're working to control the effects of COVID-19. And this next point is also encouraging. There's been little damage to internet, to communications, to transportation infrastructure. And honestly, with the government shutdown, there's almost a post-war-like pent-up demand to get out of the gate. And the companies we're seeing in the market are looking at their supply chains. They're seeking to improve them. They're seeking to look at the steps that their own governments have taken to stabilize their own economies, both for individuals and businesses. And this is actually producing a surprisingly strong restorative effect on psychology and commerce. This said, in the U.S., there's been less bipartisan issues and infighting within our own government in the U.S., and we can see that they're looking to the future almost shoulder to shoulder moving forward with this. So we're finding that there's been limited damage to communications, and people are starting to work together. That then again, oil and gas, they have been allowed to return to some semblance of normalcy. However, we're hoping that they'll be permitted to raise in price. And this touches on the fact that the government mandated shutdowns and lockdowns are really having an effect on airlines. They're having an effect on, of course, cruise lines, and which use, of course, oil and gas. So we're hopeful that OPEC plus countries, and especially Saudi Arabia, can permit the price of oil to rise a little bit. And that's part of our bull case. And then last but not least, there's this newfound sense of survival gratitude. If anyone opens up Instagram or Twitter feed, you find stories about, yes, the apocalyptic view of what's going on today. But then again, there's also this lifestyle rethinking, this life rethinking, national purpose and goal setting, prioritization of reaching out to people who are alone. And there's innovative technologies coming out in business and so much energy in the markets today. It's an affirmative direction, and there are a number of countries in every region that are reaching new high ground with advancement and restoration. So those are our bull and our bear case that we see in the market today. And so what drives this preparedness in the market? So we want to bring this toward the topic today. And Refinitiv is a large data company. We have, I think the official word is a massive amount of data, and the breadth and depth is phenomenal. I work with data scientists each day, and what they are able to produce from the data that we have is amazing. But what drives preparedness in the market? It is data. And so one of them is data. You can see the Refinitiv data catalog in the background. It's not the full data catalog, but you can see just the amount of information that we have. And data is increasingly becoming the lifeblood, not just of wealth management, which it is, but it is the lifeblood of financial services. When you think of, I'll use a relatively cliche phrase here, knowledge is power. You can't make decisions unless you have the knowledge, and these days, data is the knowledge. So for companies and wealth advisors, they can harness the power. If they can harness the power of data and take data more seriously, which many wealth advisors are, this will leave them in the best position to serve the clients. And additionally, through data, and not just through Refinitiv data, but high quality data, it will help investors and clients identify these high quality assets. And in this time, it's exceptionally important to find companies that have fortress-like cash-rich balance sheets, dividend strength, defensible business models, and return on equity that's over long time frames that's acceptable and high. So the power of data is something that is driving the markets today. And the second thing that is driving the markets today is, of course, digitization. So the trend toward digitization is not surprising. Before COVID-19, in the quote-unquote old world, there was an increase in the number of tech firms, both small and mid-sized, that were entering the market with new tech. This is definitely in wealth management, which Francisco knows, and they're focused on basically one thing. They're focused on the client experience. That's where they can gain their competitive edge. So the digitization is not just important for the small firm to gain an edge in the market. It's a trend that we at Refinitiv in our research have found that larger firms are refocusing on too. And so the major areas that we see these larger wealth advisor firms focusing on is, one, that client experience, and number two, operational scale. There are many large firms that want to ease their battle with the fragmented back office infrastructure that they have. They want to pull up the fences and not have their information and business units so siloed. And then they additionally want to transition away from legacy systems and really truly enter this new and exciting era of fast technology and big data. So I know Francisco will probably talk more about these two trends as well, and especially what's going on with BlackRock. But we at Refinitiv are very focused on our wealth advisors, and I'm excited to share today as well that we have upgraded our desktop solution called Refinitiv Workspace, and even this month we're going to do a launch of it in the Latin American region. So should you be interested in what this means, how Refinitiv focuses on the technology, quick numbers in processing large amounts of data, and the comprehensiveness of our data catalog, please reach out after this and leave a note for us, because we'd be more than happy to tell you about it. As we see from our research at Refinitiv, and we research many different areas of financial services, and to see how best our clients can not only utilize our data, but what they're really interested in the market. And you can see here that on the left side, that client focus is key. Client focus is key. These two charts are from a survey that we did within our research team and content team at Refinitiv that surveyed a number of wealth advisors, and we're really trying to find out what was on the top of their mind. And having client services is absolutely essential to their success. Clients are now becoming more and more demanding in the seamlessness of how they experience the platforms with which their money is being held and their funds are being managed. So the client focus is key. Additionally, you can see that the second bar there talks about information and talks about how the client is truly top of mind for our customers. And the information segment goes right back to what I was talking about before with the data. Our wealth advisor customers and clients like the amount of information that they can get, not just from Refinitiv, but they need that information to be able to process and to be able to segment out which clients and which customers can be targeted for the best products that they have. Now, on the left hand or on the right hand side, this chart, you can think of this as this trend as wealth advisors, these large wealth advisors are often wanting to align themselves with getting the house in order. And that means they're focusing on operational scale. Large firms often have many different products, and as we mentioned, there can be siloed legacy platforms, legacy systems, older infrastructure, and being able to scale the new and exciting technologies that they themselves within their own innovation teams are coming out with is very exciting. And then secondly, you can see there, it's in the box, analytics are essential to the wealth advisor. And this is one area where clients are even more requiring of the wealth advisor. They want analytics. They want to see all of the numbers. So these analytics are not just useful in-house to the wealth advisor, but the customer is also requiring more of them too. So with that, I want to pass it off to Francisco Rosenberg. Francisco, we are so excited that you're here and to tell us about what's going on at BlackRock and what the wealth management space is bringing, how people are dealing with this new world that we're living in. So I'll leave it to you to take it away. Thank you.
Thank you, Natalie, and all the Refinitiv team, and of course the audience. We thought that the best way to tackle this was to start speaking of the trends we are seeing in the markets and what are the conversations we are having with the clients. So we're going to share our market views. These market views can be accessed in the BlackRock Investment Institute site, or you can contact us, chile@blackrock.com, and we can help you find them. So in the old world, taking quote from what Natalie said, we started the year seeing an acceleration in growth, considering monetary policy was in the traditional ways exhausted, and the China-US trade relationships were not going to be a topic this year, which in essence started as true at the beginning of the year, but now they're back in the plate, not so much about trade, but maybe about the blame game regarding the COVID outbreak. So there's three themes we are seeing in the new world. Activity standstill. Activity has been frozen, economic activity. We see that the shock has been greater than what we saw in 2008, but we believe its cumulative hit growth is likely to be lower. The main risk to our view is that the policy that has been announced by governments and central banks needed to bridge business and households through the shock fails short, and this is something we are monitoring constantly. Then comes, we always at BlackRock talk about, in a way, cause and consequence. We can say that the activity standstill, it's not a cause, it's a consequence and an intended consequence of policymakers. The economy has been in a free fall because it has been a decision to try to slow the outbreak of COVID. And a reaction to the activity standstill has been bold policy action. We have seen drastic response from governments shutting down economies, creating this free fall in activity, drastic public health measures, and a decisive preemptive coordinated policy response needed to stabilize financial markets. the Fed clearly is leading the road. The aim for these policies is to forestall cash flow crunches among small business and households that could lead to further financial strength and tip the economy into a crisis. We think that central banks are trying to avoid a liquidity crisis transforming into a solvency crisis. That's why we have seen unprecedented stimulus, and I think the word unprecedented is getting old. Every year we hear unprecedented, but the magnitude of the sub-monetary stimulus and fiscal stimulus has been incredible, and we'll give some numbers later during the presentation. One thing that stays true during the last couple of years, and we were saying it in the old world and we say it in the new world, is resilience, resilient portfolios. And that can take many forms, talking about having in your portfolio government debt, which is practically not yielding absolutely anything, but works as a shock absorber in portfolios. And when looking at quality at equities, thinking about different factors like, for example, quality or sustainability, which we can touch base later, which if you see, there has been a lot of conversation around sustainability, and the returns have been there for the last couple of years, but we have seen this more aggressively during the first half of 2020. So, talking a bit about these three themes, we have seen major economies locking their economies. We can talk about the US, Italy, France, Germany, Japan, and of course China, which started before. And we have seen how the contagion has been slowing, which is the objective, not to have a situation in the healthcare system. So this is working as of now. The big question is, as the economies start to reopen gradually, how is the possibility of having a major second wave of cases? And that is key to understand if governments could choose to return to lockdowns and dampen further activity, or continue opening up their economies. Those are clearly some variables we need to watch. The economic activity has frozen. It has not stopped, and it was intended. This is not 2008. We have a credit crisis and the economy starts slowing down. This was done on purpose. If you see composite PMIs of developed and emerging market economies, you can see they were trading around 52, which is expansion, before February, and they dropped in a matter of weeks to around 37. That same drop occurred in the global financial crisis, but it took over 1 year and a half. It started at the end of 2007 before bottoming up in 2009. So in terms of economic contraction, you saw the effect of the global financial crisis in a couple of weeks versus a full year and a half in the previous crisis. But that also brings into perspective what the thing going forward. The hit to economy has been much more aggressive than it was in the previous recession, in the previous risk-off scenario. But we think the cumulative economic impact over time, which is key for asset prices and might be a question and the reason why there's this divorce between asset prices and the economy, will be likely less this time than after 2008. Why? Of course, monetary and fiscal intervention, but also in 2008 we had a financial crisis, so the initial shock in activity propagated through extended debt deleveraging cycle. And we see the Fed trying and other central banks trying to avoid this deleveraging trap. Now, talking about the Fed and central banks, I invite you to pay attention to these numbers, which again you can find in our site because they're incredible. Central banks, especially the Fed, have deployed their full range of tools and have invented new ones during this year in a far shorter time frame than 2008. If we compare the Fed's balance sheet at the start of the crisis, let's call it September 10, 2008, the Fed balance sheet was around 1 trillion. It ended up the expansive cycle after different QE programs. In 2014, the Fed balance sheet stood at 4.5 trillion. So it multiplied by 4 at the time. And before it started what was called, instead of QE, QT, quantitative tightening. So the Fed balance sheet was reduced in 6 years from 4.5 trillion to 4.2. And on March 4, different announcements were made. Securities purchases, which are different in this case from the ones in 2008, because they do not only include treasuries and mortgage-backed securities, they include investment grade, another type of debt like junk bonds. They also include money market and commercial paper facilities and payroll protection and Main Street facilities. We estimate that the balance sheet of the Fed was around 4.2 trillion, as we said, around March, and we are seeing that it could end the year 2020 at around 11 trillion. So in the course of 9 months, you will see almost 3 times the stimulus that was delivered in 6 years to address the global financial crisis from 2008 to 2014. So for us, it's clear that central bank policy has moved from alleviating dysfunction of market pricing and avoiding tightening of financial conditions to ensure the correctly functioning of credit markets, and actually that credit markets flow to business and local governments. The other central banks, China, the Eurozone, Japan, in terms of developed markets, continue their plans, but are lagging the Fed. They have increased their balance sheets. We expect growth there as well, but not similar to the case in the United States. And probably we will need more announcements from their part. But monetary policy is not alone here. There's other side of the coin, which is fiscal stimulus. In the old world, at the beginning of this year, BlackRock was expecting a global fiscal impulse from G3 economies, US, Eurozone, Japan, and China. The fiscal impulse is the percentage that impacts global growth, either positive or negative. We're expecting a positive impact in fiscal impulse of around 0.5%. Now, after all the announcements you've heard, and probably you heard a lot of this, but the incredible thing is when you try to quantify what is being done. We are seeing fiscal impulse of around 6%. During the last 17 years, the highest level we saw of positive fiscal impulse was in 2009, and that was near 2%, 1.8. So we are seeing unprecedented, as you said. We're going to repeat this word a lot, and we repeat it a lot at BlackRock. Unprecedented monetary stimulus and unprecedented fiscal stimulus. And that has consequences. We are going to see the balance sheets of many economies grow aggressively. We see developed markets have the possibility to do that. So our estimations, if we consider IMF latest estimations, was a debt to GDP in the US of a little bit over 100%. Now we are seeing, depending on how much guarantees does the US give to these loans, if it guarantees 25%, it has some not so big impact as if it guarantees 100% of these loans are given to the real economy, to the business. But we could see the US debt to GDP in the US be around 140%. So we're seeing fiscal stimulus, we're seeing monetary stimulus, so in essence, monetization of this debt. We don't see this as a problem since inflation is absent right now, considering that activity is frozen, but this is something to monitor in let's call it the new world once we stop talking about coronavirus. And then something that, of course, you have been reading on the news is the unemployment rate. And if you see the U.S. initial jobless claim have skyrocketed, we think we are still not past the peak there. And usually the U.S. unemployment rates follows, of course, initial jobless claims. So if we see the amount of initial jobless claims we have seen and try to model how this could impact the unemployment rate, we could be easily speaking about unemployment rate going to about 20% in the next couple of months in the United States. Remember, this has just happened a couple of weeks ago. Whenever we compare to global financial crisis or even the Great Depression at the beginning of the other century, this happened in the course of years. So this is not a financial crisis, a credit crisis. This is, in a way, a humanitarian crisis. But we think policymakers have understood the severity of it and are trying to be a bridge until activity resumes. It's going to be key to see how in the economies that are returning to labor, to see how the rate of contagion continues. If we see a massive increase, we might have more headwinds ahead if the government decides to shut down again the economy. So those are our main concerns to our central view, which in terms of implementation in asset classes is not negative. We are neutral on equities. We started the year positive on equities. That's a change. But we are favoring credit, especially, and in some cases, when we talk about credit, we are talking about risk assets. So if we touch base our granular tactic views, in terms of equities and regions, we are overweight U.S. equities, mainly for the relative quality bias and what we already mentioned, the sizable policy response, either from monetary or from fiscal. And we think the high-quality companies that are trading on the U.S., mainly technology and health companies, have an advantage. And that's why we have seen, again, we see this every year over the last decade of the U.S. Outperforming its peers. We still are overweight when we touch base on emerging markets on Asian equities. We see prospects of eventual growth uptick, especially in China, as they're ahead in the curve of the recovery. And we are worried about Europe and Japan, especially because they're heavily dependent on foreign trade. And of course, given the current situation, we think that that's going to take a longer time to recover. If we look at factors, we do like minimum volatility for its defensive properties in a growth slowdown, and quality. We like it. It has been a resilient in late cycle periods despite relative high valuations this factor is experienced. We already mentioned we like treasuries as a ballast for the portfolio, as a hedge for risk-off scenarios. And we are quite constructive on credit. And on credit, we're referring to investment grade. We have seen valuations turn attractive and increasing spreads, and we have the support, the monetary support from central banks, and high yield, obviously, taking care of some sectors, especially the energy sectors. When you strip out energy, yields are attractive, but not as attractive as when you include them. But the implied default rates are much, much higher than history suggests could materialize in the sector. As I was referring, many of the figures and information I mentioned during the presentations are available in our website through interactive charts. Some examples are our GPS tracker, which tracks our view on economic growth for GA3 economies and China, and our geopolitical risk dashboard. Again, geopolitics has been not a theme we have been discussing aggressively, and it was a big theme during the last couple of years. We think that's going to return once we move away from COVID conversations. I know, Natalie, if you want me to touch base before going to Q&A of some trends we have seen from different surveys we have done from clients.
Yes, please. Absolutely.
Perfect. Something really curious is some trends in terms of the risk-on, risk-off behavior of our clients. If we were to speak on clients at the end of March about buying the dip in markets, we saw that 75% of them were eager to cautiously starting money to work, money in motion into the market. either equities or credit. But if we look at May 11th, Monday, not so far away, only 60% is. So we have seen as market started to recover, how clients are being more worried about the possibility of the market testing again the lows we've seen around end of February, beginning of March. And when talking about credit, with credit back in focus and comeback in flows, we have been asking clients how are they allocating their exposure. Around 50% are tentative returning to the asset class with quality assets. Let's call it government debt mainly and investment grade. But then the second most chosen answer is risk on, especially higher yield in investment grade and high yield. Only 5% is continue to take off risk of their portfolios. In terms of equity, where do clients from a regional perspective have more conviction? No surprise here, 56% to US equities, 17% to European equities, and 10% to other developed market equities. So we see quite a risk-adverse scenario from clients to emerging market equities, including China, including Asia. And when we talk about how they want to be selective in equities, we see that almost a third want to be selected by sector. Incredibly, we're seeing that 30% by stock picking, and then by region, by factor, and by country. So we have clearly see a differentiation between sectors. In BlackRock, we see a lot of dispersion in countries, although it hasn't been captured in this poll. We, as countries, have applied different economic stimulus, different containment measures, and actually some are releasing their economies, and other ones are still strengthening the lockdown. We see that we're going to see a lot of dispersion in in-country returns. Natalie, I don't know if you have any questions or some questions from the audience.
Yep, thank you for that, Francisco. That was wonderful to hear. I know that that ESG is consistently on the top of the minds of the minds and the lips of our customers, of our clients, and every person on the street talking about climate and what companies can do to be better, do better, have more sustainable or green investments. Can you talk a little bit more about the sustainability of and how that folds into the structure of your everyday and the work that you do?
Perfect. I think it's the question is right on timing in what we have been doing at BlackRock during the last couple of years, and actually what's going on with the world. We think that I think it's not nice to say this, but in a way, COVID has accelerated some of the sustainable conversations we were having. At BlackRock, we believe it's always time for green investment, and that ESG criteria is here to stay. Our view is that companies with strong performance on material sustainability issues have the potential to outperform those with poor performance, and we have empirical evidence showing that. In January, our CEO, Larry Fink, shared his letter to stakeholders where he announced many long-term changes we're implementing, among our implementation of ESG screening in our portfolios. Let me mention some of the steps we were taking. Making ESG funds the start and building blocks in multi-asset solutions, such as our branded model portfolios. Strengthening sustainability integration in active portfolios and our investment process. Reducing ESG risk, including, and this is really relevant, by exiting investment with high ESG risk in active portfolios. As an example, we're in the process of removing from our discretionary active investment portfolio the public securities, debt and equity of companies that generate more than 25% of their revenues from thermal coal production. And we aim to accomplish this during 2020. Probably you've seen in the news, we launched new ESG-oriented investment product as well as ESG version of existing active funds. We are strengthening our commitment to sustainability and transparency in our investment stewardship activities. We believe there are 4 forces that will accelerate sustainable index adoption, and we see 1 trillion in new assets in the next decade, by 2030. One is pretty clear: recognition that sustainability influences risk and return, and the performance is there. If you take the MSCI KLD 400 Social Index, which selects U.S. companies with high ESG ratings and exclude companies engaging in controversial industries and severe controversies, this benchmark has delivered over 100 basis points over its parent index, the USA Investable Market Index. Better data leading to better indexes. More companies now are reporting ESG information, and that is happening around the globe. Access to ESG at a fraction of the cost, of course, through indexation, and sustainable choices for every portfolio. Looking at year-to-date activity, during April, we saw 5.1 billion added to global ESG ETPs, exchange-traded products, in April. Year-to-date, that figure is around 20 billion, which was 3/4 of what happened last year. So the trend has been accelerated, Natalie.
Great, thank you for that. And I want to comment how Refinitiv often impresses me. I work in the innovation arm of Refinitiv, and what we do in ESG, not just for our desktop solution, which is the live product that we have available, but I work in the innovation side, and ESG is one of the projects that we work on, and we combine basically all of these different data sets, including news, sentiment, to not predict which ESG controversy may occur, but it looks at the track record of companies for the number of controversies that they may have. And so I'm finding that as you were speaking about how companies that are acting better and have a more sustainable way of managing themselves, it comes into play for both investors and clients. So thank you for that. There were 2 questions in the chat, and please leave your questions in the chat box. We're excited to answer them. One was about the rate of inflation, and let me read it here. What is your opinion on the level of inflation that could result from the Fed's strong balance sheet expansion? Now, Francisco, I will leave you a couple moments to prep that question and go to another question in the meantime. There was also someone asked about what about high yield bonds in the U.S. or high yield ETFs and funds. And I want to say that the trend over the past, I'd say year to date, is that the high yield funds in the U.S. are down. They're about 10.2% as of last Friday. That said, they were up for the week, but they were down. And if we look at other funds, we look at the Treasury inflation protected, intermediate term funds, the Treasury long terms. Those are all up quite a bit. So that would be 4.1% for TIPS. The IEF is 10.3%. Treasury long term is 21% up from year to date. And then you see the high yield is down 10.2. So I'm going to echo exactly what Francisco is saying here when he talks about high quality. I think, Francisco, you've said that a bunch of different times on this call, and I want to echo it once again. Caution and conservatism often is the right path forward in uncertain times. And so you want to make sure that what you're flying to is very high quality. And so those are the comments that I have regarding high yield within the U.S. And Francisco, you're welcome to comment on that as well.
Well, thank you, Natalie. On inflation, of course, that is a really time question, and probably the question we have been asking ourselves during the last decade as we have seen different type of stimulus being implemented. We don't see inflation as a short-term risk in developed economies. It can be different in some emerging markets in which different type of stimulus. Emerging markets do not count with the luxury of printing money and not having consequences in their currency, and the evaluation of their currency then can bring inflation. In the case of the U.S., as first, we have activity totally frozen, and the speed in which the stimulus is withdrawn once activity returns to normality will be key to see inflation. Now, we think that the Fed might be willing to let inflation run a little bit higher this time. It's probably not, I mean, a lot of things have happened, but last year the Fed changed how it screens for inflation away. The Fed's mandate was to act, of course, versus against unemployment, and when inflation reaches around 2%. It changed its mandate to have an average of 2%, meaning that in a certain period, inflation could shoot up over 2%, and the Fed shouldn't be, let's call it, obliged to raise rate or tighten monetary policy to counteract, because now it's not a, let's call it a nominal number, it's a weighted average. But we think the Fed and central banks during this decade have been acting against nominal rates. That's how they try to stimulate the economy. Going forward, their tool might be real rates, and to have real rates to push for money into risk assets, into risk in the economy as well, you might need to let inflation run higher. Definitely something to consider, but I would say not in the short nor medium term.
Great, thank you. There was a question about when there's a tremendous amount of debt that the U.S. has put on its balance sheet right now, and the question is rightly so, where does it end? And I want to bring this back to what we do know and what we don't know in the markets today. With the torrent of news and news coverage, we're all equal in our knowledge about the future at this point. Companies are not even releasing what they estimates will be in the future because they're equal in their knowledge about the future. The knowledge is that we're equal in that knowledge, but we're also equal in that ignorance about the future. When we talk about the U.S. debt right now, the Democratic Party, they just came back from their recess, and they have proposed a new $750 billion deal to the U.S. government to help small businesses and help those involved in unions. And we'll see where that goes to. However, at this point, no one can say for sure when and where it ends, but the protectionist policies that are in place now that are meant to help the U.S. economy, we're going to see how they play out. We know there are a lot of different elements in the market today, but I will acknowledge that, yes, there is a tremendous amount of debt, and I wish I knew precisely the answer to your question, but we'll see. We'll see. Francisco, if you want to comment on the expanding balance sheet of the U.S., we'd love to hear your thoughts.
Yes, I mean, it's astonishing. I'm guessing the audience took as a shock the numbers we gave during the presentation. It's interesting, right? The U.S. prints and the dollar appreciates, and all the other currency devaluate versus the dollar. But it's in a way that's how the financial system is constituted, in which the dollar is the currency reserve for the world, right? And there's demand for dollars. So although we have this massive increase, there's still demand for it. And we think this will continue. So where does it end? GDP, debt to GDP in the U.S., if our estimates are correctly, we could be around 140% by the end of 2022. Japan, before the crisis, sits at 220, and the yen is still a strong currency. So definitely it's an unknown, but of course it all depends how all this amount of stimulus is withdrawn once the activity returns to normal. This shouldn't be a normal situation, and it's really different to the stimulus that was provided during the financial crisis, because we are having massive deleveraging from insolvent companies. Here we are not talking about insolvent companies. We are talking about companies that are not being able to operate. So once this resumes, we think that most of the programs that are being put in place can be wind down. Even if you see the Fed programs that were announced, most of them have an end date during 2020.
Right, and one note, I'm glad you brought up the strength of the dollar. Last week, the dollar rose quite a bit and strengthened quite a bit amongst a few different nations. We're talking, Argentina, Switzerland, China, India, of course, given that they had their market had gone down so much last week, Brazil, and even the European countries. So you're right in saying that there is more demand for the dollar, even though the Fed's balance sheet has expanded as much as it has. So I think that's hopeful, at least for the U.S., since many of these currencies and many companies hold on to the dollar quite a bit. And I think we're going to move to any last questions anyone has. Go ahead, Francisco.
No, that we are seeing that because also we are seeing many other countries pursue similar activities than the case of the United States. We are seeing type of QEs in emerging market economies, and you are seeing that affecting those currencies.
Great. Thank you for that. So I'll leave about 15 more seconds to see if there are any last questions. We welcome them. We're excited to answer them. Francisco, I speak for me, and I will speak on behalf of everyone in the audience here. Thank you so much for your thoughts, and it's really interesting and exciting to hear what BlackRock is doing and has done in the past, and of course your market commentary. It's phenomenal to have a discussion with you, and we look forward to doing more.
Thank you for having us. Looking forward for our next invitation, and of course, thanks to the audience for their time.
All right. With that, we'll sign off. Thank you to everyone in the audience, and thank you, Francisco, and to everyone on the Refinitiv side who's managed the logistics here. Have a great rest of your day. Bye now.
Bye.